It was 2 in the morning and I got the call. My business was literally on fire. And this is February 16th, 1998, right before the heavy part of tax season, with over 700 tax returns still to be prepared. To make a long story short, I was able to get through the tax season. The office basically was destroyed. The only paper that really survived intact was the paper that was in our fireproof drawers. Luckily, the computers were backed up to a T. We had to move literally within days, and finally we were back up and running. But that year, I had all these massive expenses of the fire and putting everything together, and I didn't get reimbursed until the following year when the insurance company gave me the full reimbursement for the expenditures I had. And I had the lowest income that I'd ever had or will likely ever have again. And I said to my wife, hey, this would be a great year to convert our entire IRA, we were in our 40s at the time, to a Roth IRA. And we had about $250,000 in our traditional IRA, so this was going to be a substantial tax bite. And my wife, who doesn't like to pay taxes, but she's a smart cookie. She has a master's degree from Carnegie Mellon in electrical engineering. And she said, well, gee, let's see if this really makes sense. Anyway, back then there wasn't any software to, quote, run the numbers, and we didn't really have any assistance, but we did it manually with an Excel spreadsheet. I was able to prove to her, yes, this was a great idea to make a Roth IRA conversion. We converted our entire $250,000 into a Roth IRA. Our family will be over $1 million better off because we did that. And if I am wrong about Roth IRAs and Roth IRA conversions, which is our topic for today, then I am going down with you, because I literally put my family's money where my mouth is. And one additional story, or one additional lesson to this story, is my office, which was above a pizza shop at the time, suffered an electrical fire from the pizza shop. And the additional lesson is never, ever put your office above a pizza shop. Anyway, we're going to have some great information, mainly about Roth IRA conversions, but we're going to go a little bit beyond that today, but mainly Roth IRA conversions. And this will be a terrific workshop for you, particularly if you have a big IRA, maybe even the majority of your wealth is in your IRA. And when I say IRA, I will expand that to IRA, 401k, 403b, SEP, KEO, etc. And that you want to protect yourself and your family from the massive taxation that will occur if you don't take any proactive steps. This webinar will be even more valuable to you if you are data-driven. So what am I talking about? That is, if you are shown, perhaps on a spreadsheet, let's say the difference between maybe a number of different scenarios, including a scenario that you might have had in mind as the best future course of action, to the one that we might think is ideal, and we're speaking specifically about Roth IRA conversions. On the other hand, when we run the numbers and do our financial master plan, Roth IRA conversions are only one component of it. But if you are shown that there is a better way, and we can show you this with undisputable proof on an Excel spreadsheet, that you have an open mind, and better yet, you're even willing to take action. So that's what I would say is my definition, if you will, of being data-driven, even if you had a different concept of your, let's say, your mental master financial plan, and if you're shown there is a better way to do it, that you will be open-minded enough to do it. And the other thing that would really help me is if you could put a Y in the chat if you consider yourself data-driven, because I think that this webinar will be more beneficial to you, and particularly if you are willing to actually take action from the information that you learned. I heard an interesting definition of learning, which is learning is a change of behavior based on new information. So in other words, it would not be terribly satisfying for me if at the end of this webinar you said, wow, that was great information. I really learned a lot. Now I'm going to go back to my life and I'm going to not take any action based on the webinar. It would be much more satisfying and much more valuable to you if you said, hey, I learned some new concepts, and either on my own, with my existing advisors, potentially with the help of Jim in his office, we're going to take some action to protect ourselves and our families from the massive income taxation that is virtually certain to happen without taking any proactive steps. So I'm trying to put myself in your shoes and say, well, gee, what would I want if I am, let's say, an IRA owner, retirement plan owner, and I am either approaching retirement or I am perhaps retired. And what would I want if I could just wave a magic wand and then all of a sudden it would happen? Well, first, I would love to not be burdened with all the worrying that so many of my clients have. They just worry, and it's just about their money, and they worry about running out of money. They worry about whether they're making the right decisions. They're worried about money for their family, for their children, for their grandchildren. And one of the reasons that they worry is not necessarily because they don't have enough money. It's because they don't have enough information. They don't know how much money they can afford to spend. They don't know if they're doing the right strategies. They don't know if they have the right estate plan. They don't know if their wills and their trusts and their IRA beneficiary designations are set up optimally. So this sense of not knowing is a major source of the worrying, in addition to perhaps not thinking that you have enough money. You would like to have all these things taken care of. You'd love to have a grand master plan that takes into account your income, your assets, your needs, your family situation, your kids, your grandkids, the coming tax changes. How much money should you convert to a Roth if appropriate? When should you convert to a Roth? Should you be making gifts? Is your wills, trust, and IRA beneficiary designation set up? And is it part of a holistic plan where one part impacts the other and it's set up properly? That's what I would want. And of course, you can't wave that magic wand, but it is possible to have this plan done, not tomorrow, but I would say within a 3 to 6 month period. And then after you do have this plan set up, again, incorporating wills, trusts, IRA beneficiary designations, Roth IRA conversions, gifting, grandchildren's education, et cetera, you'll have this wonderful feeling of, gee, I really optimized my planning. This was going to be a major benefit for myself, my spouse, my kids, my grandkids. You'll know that you have planned well for your family, and you'll be in a much happier position. And very frankly, that is what I would love for you to have with or without my office's assistance. So this webinar today, and it is, I've been talking about Roth IRA conversions since 1997, even before they were law. So I can't say it's a new one, but I will say it is newly updated. I have not presented it in a webinar format like this at a national level, even though I have, and I've, by the way, given all day Roth IRA workshops for financial professionals. How do you like that? 8 hours of me talking about Roth IRA conversions. But this is let's call it the pared down version. And what we're going to talk about and what you will discover by hanging on and watching this webinar is you're going to learn some critical concepts. And we're going to talk about purchasing power. And that is such a critical concept that very few CPAs and estate attorneys and financial advisors talk about, let alone understand. We're going to talk about some other critical concepts that are critical for IRA and retirement plan owners. So if you have a $10 million business and maybe a $200,000 IRA, this webinar might not be for you. But if you have it the other way, you have maybe the substantial portion of your wealth in an IRA, and again, 401k, 403b, 457, etc., then this webinar is going to be right on point. We're going to get into a little bit of the nitty-gritty math of Roth IRAs and Roth IRA conversions. The other thing that we're going to do, and we have not done this before, is we're going to get into some of the nuances of Roth IRAs and Roth IRA conversions. And it might seem like small things, but again, it can make a difference of tens to hundreds of thousands of dollars. And I'm just talking about the small differences, not the big differences that Roth IRA conversions will make for you and your family. And the other thing is we're going to try to put Roth IRA conversions into perspective of the rest of your plan. And of course, we have to be talking about gifting because it's just such an important critical element to the response to the Secure Act, which, by the way, Roth IRA conversions are one of the appropriate responses to the Secure Act. And we're going to talk about the Secure Act also. I am going to be taking questions again between 1 and 3 Eastern. I'm going to be taking, it's 2 hours of questions with me. And, but I am going to be taking some questions during this webinar. And if you have a question, please type it into the chat and I will answer as time goes on. All right, so what are some of the major themes? Let's step back a moment from Roth IRA conversions. What are some of the major themes and what are some of the logical and I would say critical responses to the election and a new Senate and House? Well, the new environment, if you will, is that income tax rates are going to go up. All right. And we'll get into the specifics of when and how much. Of course, there's no certainty about that, but certainly the direction of income taxes is going up, and we will talk about why. And we will talk about a logical, let's say, global solution, which is to, if we know that income tax rates are going to go up, it makes sense to take some of the assets that we have that are in the taxable world. So what am I talking about, assets in the taxable world? I'm talking about, again, IRAs, 401ks, 403bs, SEPs, KIOs, etc., because what all those assets have in common is unless we leave that money to charity, when we withdraw money from our IRA, 401k, etc., or perhaps we die and our spouse or our kids or our grandkids or whoever the beneficiary is, anybody other than a charity, they will have to pay income taxes on those IRAs and 401ks, etc. If we can lock in tax-free growth when tax rates are lower and then withdraw that money, or perhaps our heirs withdraw that money when income tax rates are higher, we are going to have a lot more money for ourselves and our family. So we're going to talk about some of the income tax planning for IRAs, 401ks, 403bs, etc., and as well as estate planning for 401ks, 403bs, etc. So obviously, if we're talking about going from the taxable environment to the tax-free environment, the first logical thing that perhaps or hopefully comes to mind is to do a series of Roth IRA conversions, okay? Because you're taking a taxable asset, again, IRA, 401k, 403b, etc., and you are paying taxes on that money, and what you get The result after you pay tax on that money is a Roth IRA that's going to grow income tax-free, hence shifting from the taxable environment to the tax-free environment. Now, there are other ways to get into the tax-free environment. You take a traditional IRA, you pay taxes on it, and then you take what is left, and perhaps maybe in certain circumstances even better than a Roth IRA conversion, you get that money outside of your estate. So how could you do that? You take some money from your IRA, you cash it in, you pay taxes on it, you take the net proceeds after you've paid taxes on it, and you make a contribution to your grandchild's 529 plan that grows income tax-free as long as that money is eventually withdrawn for educational purposes related to college or a trade school. So that would be an example of going from the taxable to the tax-free environment. And in that situation, since it's a 529 plan, which is not in your estate, you're not only going from taxable to tax-free, but you're going from taxable to tax-free for income tax purposes. And then you're also going to tax-free for estate and inheritance tax purposes. And the same thing with life insurance. Again, that's where you're taking some IRA and 401k, et cetera, money, paying tax on it, having some after-tax dollars left over, and then using that money to buy a life insurance policy, assuming it is set up correctly, that life insurance policy, and when the policy matures, which is the insurance guy's euphemism for when you and your spouse die, the proceeds of the policy are income tax-free, estate tax-free, inheritance tax-free, etc. Or you take some of that money from your IRA, cash it in, have some after-tax dollars left, and you use some of that money, you gift it to your heirs, and they put money in their Roth IRAs, their Roth 401ks, their Roth 403bs, etc. So all these are methods of going from the taxable environment to the tax-free environment. And all these methods make sense even in a steady income tax environment. If the income tax environment is that of a raising tax rate, both for income tax purposes and estate tax purposes, then these strategies can literally save sometimes tens, hundreds of thousands, or depending on the size of the estate, even more than $1 million for you and your heirs. All right, so